Welcome to TradeTheMBI.com. This is John. This report is for the 9th of February. And unsurprisingly, where are we at here? 50.21, currently at 19. And I said around 23 to 35 would be a typical move before you start to see some retracement. But we're seeing even stronger support here with Cyan continuing to significantly drop on the DOC, suggesting that this is literally up to bulls and how much buying. We already got a renewed uh, gold rising here on the shakeout, and you saw the last effect of that. So nothing in the way of continuation as far as we can see at this particular stage, barring any special news. We have the revisions for CPI and some of those other things coming out, which will be interesting to see how that number fudging really relates to the real world. But everyone already knows the inflation rate that's reported isn't exactly what is experienced, particularly when it comes to buying, your set basket of goods. Nasdaq also making a similar move, and pretty much identical, but much stronger from its shakeout readings already. It had already been in this rising gold nature, which suggests a strong momentum to the moon. So no question about any of that. Treasuries moving back towards a higher yield as a recognition, perhaps, that as things continue along, bond market got way out of hand when it came to the idea of rate cuts and the belief, and particularly if those CPI numbers come out differently, certainly will have an impact. And this is also a major uh, drag to the idea of rate cuts as oil continues massive climb, because inventories continue to decline, as well as really the more significant side of it, refinery capacity, as particularly in the West, where building a refinery is nearly impossible, and so you get a squeeze because there just isn't enough capacity. You can drill all the oil you want. If you can't process it, what good is it? That's a whole separate issue. But again, these are the upside pressures to what is causing, inflation to be a real concern, and as well as throw in the devaluation of the dollar. And the expectation is that none of the producers of these commodities are willing to suffer that degradation in purchasing power. And this is something that's gone on forever. So, no change as far as that's related until you change the fundamental dynamic of uh, what the dollar is and how it's valued. And that's been a principle for quite some time. It's amazing that somehow we've been untethered from it. From a euro standpoint, trading counter to what we're seeing slightly from oil. But again, that's going to get additional pressure, because again, it draws more resources from euros towards dollars again, because again, the oil has to be bought, except for in all those countries that are trading outside the dollar now, which is growing exponentially month by month since the conflict in Ukraine. Gold, not making a push yet, but fundamentally should. And when it does make a pop, it'll be obviously dramatic and in a significant move, much like we're seeing already in Bitcoin and some of the other cryptocurrencies, as they're becoming more favored as that alternative to the physical metal, where you can own just a digital asset, so having opposed to holding on to a heavy metal that you have to store and pay for. It doesn't really cost anything to hold on to your crypto, so it's an attractive element, particularly given its restrictive size. Not going to grow any bigger, and that makes it a relatively good store of value, which was the entire concept of cryptocurrencies in general, at least those that have a limited supply function, or those that have utility, which is where ETH and them, a lot of the backbone services in that are being provided, and this ability to move towards rapid transactions financially in that, there's just no arguing this concept. And at this particular stage, it's one of those where you're either accepting of it or you're just going to get left behind. And is it a factor if you're not dealing in a foreign currency? Well, it only matters if you're in whatever country you are, and the money that you earn is getting you less than it used to, and that's becoming apparently obvious to people at this particular stage after a decade plus of zero rate easy money because of the consequences of it. And when we move to our 50K, you can see the program took out the sell there, and this is typical of what happens within this setup. Usually we'll get the closeout, you get another push back up, and sometimes it breaks a little further, but then usually pulls back into the move. So that's kind of a standard. You can already see beginning of MBI white short interest, but as long as magenta still leads, all you're going to get is just a slowdown, but it still has strength. The question will be who fades first. If the magenta begins to fade, and particularly below the 25, then I think we'll see a much more significant retrace, meaning just to fill back in, common practice, nothing unusual. And you can see some of the erratic nature of things here in this 5-minute chart. A lot of back and forth with the eventual up climb and close towards the highs, but then in the post market it gives them the ability to fill things in just a little bit. And in this particular case, seeing that right now, it's starting to pop again here in the post market after having filled a little bit back of that. So again, it just shows there's just not a whole lot of sell interest at this particular stage. And again, we've talked about this. Some of the market appreciation, while some people may think the multiples get off, and that is not the case with inflation. That devaluation is absorbed by the market. They're not going to show a relative decline numerically to it. So while some people call things overvalued or whatever, it's a misunderstanding of the relationship between the dollar value and what it purchases versus what the market actually prints as a number. It's been a constant effect for quite some time. So the idea too, in a lot of people's mind, is that with the Fed easing, there'll be easier money, and that also is a promotion of where the market value should end up being, given what will be a continuation of devaluation of the dollar. And of course, that gets into broader macroeconomic situations. But for now, this is what we're seeing as far as how to interpret why things are what they are. And barring any major upsets, which the biggest ones would be a continued watch on oil, and a move back over that 80 level is certainly going to add additional pressures to inflation, which will certainly put a strain on economic activity. Now, it will promote earnings in that, but there's a price to pay for that, as you have to replace those goods with higher cost ones. And so by the time you get into the second, third quarter, it starts to have a material impact on net margins, and that's where you begin to notice it. But the early view of it looks positive because companies are earning more theoretically, simply because they're charging more, but they're going to have to pay for it in the end. So it just becomes a balancing act over time. And as we know, time in a lot of cases when it comes to our algo situations isn't really relevant. They're going to create their setups and moves based on valuations that they perceive and trade accordingly. So that's broad view of things, but at the end of the day, we're just going to continue to follow the readings. And right now they're suggesting things are still rosy as far as a bullish standpoint. When that changes, we'll be able to see it and react accordingly. As always, though, anything relevant, I'll put on the Skype chat. Have a good one. Trade well.